but it is what's needed for it to actually capture. So we're about to get going. And Steve, you are very, very welcome, and thank you for saying that. So Jacob, we should now officially be good to go in both places. Linda, if you'll do a quick checkaroo for us, it looks like we are. We're trying something a little bit different because we wanted to disseminate the information out as far as possible and trying to figure out for sure how to get YouTube going. But thank you everybody who joined in and is here on Zoom. Linda's in the background helping to kind of grab questions for us from actually Facebook, YouTube, as well as Zoom, so we can kind of go through the presentation somewhat quick and then spend more time to help answer questions. I will say, and I'm sure Jacob, you'll agree, before we get too started, questions that are hyper analytical to a very specific, unique scenario, we cannot answer. We can't, it's just not possible. So we'll do the best we can with that stuff, but please, as best you guys can, we want to ask questions we have an opportunity to actually try to answer. So cool. So Jacob, thank you for joining in again this time. How are you doing tonight?
Pretty good. Thanks for having me.
Awesome. Ready to get started on this thing?
Sure.
Let's do it.
I feel like we've been started for, since Friday night, right?
Yeah. I think I call this the longest year ever so far. So the intention or the purpose of this presentation, it's all focused around the SBA's recent release of the loan forgiveness guidance, which, Jake, I think you'd agree, we'll probably see new iterations of this, right?
I would almost guarantee we will see additional information clarifications come out on this. Just to start with, one interesting note is the application is actually dated 5/20. So it's dated in 3 days, which tells me there's going to be modifications that come to it, potentially even before 5/20 when it's an official release.
Well, hopefully at least some of the stuff that was really important we'll talk about is they finally talked to us about what the number of hours for FTE looks like.
Correct. So this gives us a lot of guidance on their thought process. I'm not going to say it's final, but we can interpret a lot of their thought process and how they are looking at different things, which can teach us a lot in this.
Awesome. So I'm going to get the legal stuff out of the way. This content is not intended to provide legal, tax, or financial advice. The content and materials are intended only to assist you in your general organization and decision-making for your business or practice. Accordingly, before making any financial decisions or implementing any accounting, financial, business, or other strategy, you should consider obtaining additional information and advice from professional accounting, legal, or other advisors who are fully aware of your circumstances. Presenters disclaim all warranties as to the accuracy, completeness, or adequacy of such information. So to kind of start off, there's what I felt was important to do. This thing's an 11-page document, and there's certain aspects of this, yes, you could go right into and you could read it, but I think most people just get analysis paralysis. So we need to kind of touch base on a couple important key terms and such. First one's being timelines, right? One of the things they talk about is your chosen reference period. And that, as a reminder, is when you were first establishing how you want to do your look back period, you could do it either as if you were a non-seasonal company, it would be February 15th through June 30th, or you could choose, of 2019, I should say, or you could choose January 1st to February 29th of 2020. Seasonal companies, they had a little bit different. You could use those two, or you could also choose 12 consecutive weeks between May 1st and September 15th, and that could slide to whatever is appropriate for your seasonal sales.
Those periods are for your full-time equivalent comparison. We didn't put that there. We just say comparative reference periods, but know that those are for your full-time equivalent calculations, which we will dive into more as we go along.
They also happen to have been what was used when you were trying to calculate your monthly payroll cost at the initial part of the PPP application process. So that's where it comes back into play from. So now one of the most interesting things they did is we now have this concept of a covered period and an alternative payroll covered period. The covered period is, as we've kind of all heard from the beginning, is 8 weeks or 56 days, which same thing, right? From the day your account receives its first PPP funds. Correct,
And
Jacob?
yes, so it's 8 weeks from that date. If you're one of the exclusions that ended up getting multiple funding dates because of some of the additional funding things, then it is the first day you receive funds is when that 8 weeks kicks off. So the fact that you receive funds later does not reset that. So it is truly 8 weeks, not from the date you sign your loan application, not from the date of the loan application approval, but from the date of funding, which make sure you know that date and make sure it's real. We've ran into some banks that the date on the online banking system does not match the date that it was actually funded. So be aware of that. Look at when you signed your app, know when it was actually funded, because that's when that 8 weeks would start.
That's a good point. We had one of our clients that literally was checking it every day, and the money went in kind of like direct deposit, where it went in like midnight on the Thursday instead of the Friday. So there's kind of a question of how that would be playing out. Now, there's another thing now, which is the alternative payroll covered period. This is a beautiful thing, but it also can complicate some things. So what this does is if you're running a biweekly payroll or more frequently, you actually can elect to calculate the eligible payroll cost based on the first day of the first pay period following when your account was funded, that first funding day. And we're going to have, towards the end of this, we do kind of a scenario that I purposely worked around that so we could talk more about it as well. Periodic, now kind of diving into some of the other details, like what are considered like eligible payroll costs. But did you have something you wanted to add on first, Jacob?
No, I think that was good on the alternative. The only thing I'll put out is that is only for payroll. That's not for non-covered expenses. That alternative period isn't. So even if you select alternative payroll period, your 8 weeks from date of funding is still in play for your other covered expenses.
And so I'm glad you said it that way. Throughout the entire 11 pages, they specifically will say through most of it, they'll give either one, the covered period or the alternative. You must choose one or the other and consistently use that all the time. Again, the only variance from that is when you talk about non-payroll expenses, like Jacob was just saying, those are only processed through the covered period specifically. So now, periodic, I put this as periodic payroll costs because this also introduced the idea that you've got your paid payroll costs and then you have your incurred payroll costs. And I think this can be somewhat confusing. Do you want to chime in on this one, Jacob?
Yeah, so this gets, it's not the cleanest. I'm just going to put it that way, right? The way they did this. So they said we can count both what was paid during this time plus what was incurred during this time. So this really comes into play if you use the 8 weeks from the date of funding, right? So you're going to pay the normal payrolls throughout that time. But then at the very end, you're going to have, let's say, a week, if you're on a biweekly payroll, that you can actually use, that you can now use instead of having to do that last pay period out of payroll cycle pay run, which we've talked a lot about, other people have talked about, of trying to fit all that in. You can now accrue that. So we'll just say it's going to accrual basis at the end. At the beginning, you don't have to use accrual. You're going to use cash basis. The last week, you get to use accrual basis. So you're kind of mix and matching those. So obviously, if you've transitioned to the alternative pay period, or alternative 8 weeks, right? That's aligning with your pay period dates. So while the last one wouldn't have been paid yet, it will be the full payroll. So this gets really messy when you don't align, because then you're going to have half of a payroll, or you're going to have 3 days out of a payroll that you can accrue, right? So getting those, it's not going to be as clean. This is going to cause a lot of issues for payroll companies to issue reports that will actually work for the PPP forgiveness calculation, because many times they don't have the daily hours. They just have the pay period hours. So now they can't even figure out what was incurred during that time to tell you what that number was. They can tell you what was paid during that time, but incurred, if you're not aligned to pay periods, becomes really, really hard for the payroll providers.
Yeah, we did. So it's interesting. This really does a great job focusing on the back end of this, of course, but it doesn't really take and consider the front end of it as well.
Correct.
That if you had a payroll that rolled into it, and for us, this last week, it was a heck of a week. I mean, we had almost all of our people were getting funded, and it was time to do payroll for everybody. So we literally split up payroll for these companies, and we ran one payroll on the last day before they were funded so we could have all reporting fresh and clear of that. And we did something totally, it's a Parkway thing. It's up to everybody else how they'd want to do it. Before knowing all this, we transitioned all of our people that we're doing the payroll for to a weekly payroll to where it aligns exactly with these things. And it's more work, but we got lucky because it makes this stuff
Right.
easy.
So I'll say the downside to that is since we are paid and incurred, if you hadn't done that payroll right beforehand and it rolled over into this, you could have actually counted those costs as forgivable expenses because even if you align this with the pay periods, you still have a payment from the prior pay period that falls in there. So effectively aligning with the pay periods and being able to use paid and incurred in those 8 weeks, you're going to get at least 9 weeks worth of payroll. If you're biweekly, you're going to get 10 weeks worth of payroll in there potentially as forgivable. So know that, and that is there. That's the really interesting thing to me when they say paid and incurred, because the fact that it's not paid or incurred, it's and incurred, means that with the biweekly payroll, you can get 10 weeks of forgiveness in here. We'll drop down later. That does bring up some things where you're going to not be able to get all that for owners forgiven. Yeah. We'll dive into that here in a little bit as well. I did want to step back a slide really quick and say on the alternative.
I think I'm losing you, Jacob, real quick here. So as we reset him, the other part of this, so we, as you saw here, we had at the top, of course, this is handling payroll during the last pay period. We spoke about the idea that if you have incurred it, as you can incur it and pay it later, so long as it's paid before the next regular payroll date is a very important part. Jacob, you may want to bounce out and come back in. Linda, are you able to still see him, or is that just me? There we go. Okay.
So, no, I can see him, but I can't hear him. I just texted him to let him know he can't hear him.
Thank you. And hey, Jacob, welcome back.
Sorry, I got booted out for some reason.
So you had asked us to bounce back real quickly towards one slide in regards to incurred.
Yeah, so, and actually it's not one side. I wanted to touch on the alternative covered payroll period and make sure people realized that they can only do that for biweekly and weekly payroll. And I wanted to talk about that because I did the 10-week scenario there. That's the most you could ever get. If you're a monthly payroll cycle, you're not going to be able to take advantage of that, just to make sure someone's not like, oh, I have a beautiful idea to get 3 months worth in there. Not going to happen.
Good point. Jacob jumped on that angle a long time ago. So, okay. So payroll wages, we'll go through this somewhat fast because by now, I mean, everybody's heard about what's considered part of the payroll wages, but the concept of cash compensation comes into play here a lot. And it's all focused, of course, around, principal place of residence being the United States. So we're talking the salary, the wages, commissions, cash tips or equivalent, your vacation, parental, sick leave does not include FFCRA time, which is stuff people should be looking into as well. Allowance for separation or dismissal. You've also got the employee benefits for like healthcare and as retirement insurance premiums wise. And then most important as well is for taxes, you do state and local taxes, but no federal is the fast iteration of that.
And I will touch on this really quick and say it is cash compensation. So add backs to employees, like if you have vehicle lease add backs for your employees, if you have stock option programs where some of that's flowing in, housing, a lot of those benefits do not count here. So it is truly just cash compensation. The add backs do not count because they are an add back, not actual cash.
Good addition. So then some of the additional payroll expenses, the pluses and minuses are basically trying to show you like how you would equal out what that amount would be. So, your employer contribution for the employee portion of it. But again, if it was pre-tax or after-tax contributions, that would already be, you'd have that portion would already be part of the gross and would not be in there. So you'd have to remove that from there. Payroll taxes we talked about, taxes withheld from an employer, not portion of that. It's only the employer's portion that would be eligible. So proprietors, independent contractors, of course, are handled differently. Now, the one thing that there really isn't much guidance all the way through on this, the sole proprietor and K1. Would you agree, Jacob? We're still waiting for some more like insight of.
Yeah. So the interesting thing is they actually coined a whole new term. They're going to kind of be lumped into this whole new term of owner employees, which is not a payroll term that's used anywhere. We don't know from an owner employee standpoint what triggers that from an ownership level, but I believe sole proprietors, independent contractors can be treated in that way. It is very clear that their wages portion, obviously we know for the sole proprietor and independent contractor, it is 8 weeks of last year's net income. The interesting thing, and I'm just going to touch on it here too, kind of cover all owners, and I don't think you have a next slide on it. S Corp owners are going to be treated the exact same way, and same thing with Corp owners and partners. They are going to be limited to 8 weeks of last year's average, and you will not be able to take raises for them and have it be counted for forgiveness.
Which has been about the most popular question we've received from every client is always that.
And a lot of people assumed it would work, right? Because interesting, in the rest of the payroll law, S Corp owners many times are considered employees, not owners, right? Because they're just an employee. But they are definitely calling that out here and stopping you from leveraging that.
Okay. So now we're going to get into some of the meat of all of this stuff, which has really been the area like trying to figure out how do you calculate the full-time equivalent employee account. And they introduced, again, we now have basically two options of what can be done here. The SBA suggested calculations initially basically are that a borrower is to use 40 hours per week as the equivalent of a full-time employee. Now, this is really important because in like California, when you were looking at like the Healthcare Act, everything else of 30 hours for a full-time employee, that's where a lot of confusion came into play. It's 40 hours. Additionally, though, they define the maximum of each employee is capped at 1.0. So that means if they worked more than 40 hours, you're not using those extra hours to try to lift others to manipulate the FTE count. And then the last part of that, of course, is you need to round this to the nearest tenth of a percent, or tenth, I'm sorry, per employee. So that also can change things. Then number two is the simplified calculations. And this is now going to be the biggest area we're going to see everybody talking about and everybody coming up with their unique ideas of how they can try to make this work best. What it is basically you can provide a simplified method that assigns a 1.0 for an employee who works 40 or more hours and 0.5 for employees who work fewer hours. You can elect to do it that way. So the question I would have then, Jacob, is give an example of why you would use option one versus option two.
So option two, much more simpler to calculate. So if you know you're pretty close and you know you're going to be right, option two might be the way to go, right? Just because you don't have to go back and pull near as detailed hours, things like that. You can get a lot closer. But really the perfect example for option two is, say, a restaurant, right? That employee, before we had 10 employees working 30 hours, which all counted equals 5 employees, right? Yep. And now we have 10 working 15 hours. That still equals 5 employees. And I think for that case, that simplified calculation will be a lifesaver for some of those businesses, because even though you reduced hours, they're still counting as a half. The people that were half before, even if they were working 39 hours a week, they were 0.5. Yep. If they're working 10 hours a week, they're still a 0.5. And equal from the full-time equivalent calculation, which makes the full-time equivalent safe harbor, and even not the safe harbor, just the ratio, even if you don't qualify for safe harbor, which we'll get into, that full-time equivalent ratio much more favorable than it would be otherwise.
Another thing to take into consideration, I'm sure many people are already doing this. If you're in a situation that you have people that are currently working 35 hours or so, bump them up, get them to 40. I mean, truly, even if you're paying them to just not work, that buffer for 5 hours difference is definitely worth getting them up to the 40 to get that
if
one
you need it. So, I mean, this is where, for our clients, we're saying we now have 4 calculations to run for comparative periods. Yeah. You have 2 different periods, 2 different ways to do it. You have to run all 4, and then you need to run both for the current periods, because really interestingly enough, the lowest one before could be the SBA suggested calculation and the simplified calculation higher. But when you run it for the current period, you may be high enough you want to use the simplified calculation.
Yeah.
And neither ratio may be 100%, or one of them may be, even though it's a higher number. So you really need to run this. You need to run 6 different calculations here. Right now, you need to run the 4 comparatives.
Yeah.
And then say, okay, we have the 4 comparatives, pick the lowest simplified method and the lowest normal method, or SBA suggested method. And then you're going to be looking at your current operations and saying, where are we falling in those? And obviously current operation one gets a little more involved because we have exclusions in safe harbor, which I think we're going to move into here.
Yeah, we are. Let the race for the new calculators begin. Let's see who's going to win that one. So now we're going to start, when we start talking about safe harbor, we don't actually define safe harbor until a little bit later on. So Jacob, would you mind giving a quick definition of what safe harbor is talking about?
Yeah, so basically safe harbor is, if you meet the safe harbor, you can ignore the full-time equivalent reduction in forgiveness calculation.
Yes.
Interesting in this one, typically like a safe harbor is an easier calculation. If you meet it, you don't have to do the rest of it. Yeah. Interesting in this full-time equivalent calculation, you have to do the full calculation to determine whether you meet the safe harbor. So while
unless you hire everybody back exactly and everybody's working the same, if it's literally like that cut and dry, then you're
But part of this safe harbor is the piece that many people have thought of from a safe harbor, the exemption of you let everybody off, you rehired them, now they're exempt, right? That is probably the crux of this safe harbor, is that piece of it, of exempting those rehires out and saying, as long as your employee count on 215 and 630, your full-time equivalents on 215 and 630 are the same.
Yep.
You're safe, right?
Yeah. And we, in just a couple slides here, we actually have copies of the actual form so we can show where all this stuff goes into play. So what this part is talking about is there's a 5-step process for you to evaluate the safe harbor concept. And there was actually one other piece of this we didn't touch base on with safe harbor. We've all known since the beginning that you have to keep the same number of employees working, right? The FTE, but there's also this aspect of safe harbor that's around the wages as well. And we'll tie into that shortly, but that will play into what can be exempt or not. So what this is doing is step 1 is it basically tells you, okay, you have to choose either your simplified version or your covered period. However you're doing your calculations have to be done the same through everything, so you can calculate what your FTE was between February 15th and April 26th. You're also going to do the same calculation as of February 15th, the exact day. So the first one's the average. The reason for that is you're going to look and see, as I think you were just talking about, at February 15th when it started, what was your full-time employee count at? Now, after that, all the way up to April 26th, where people started to get funded, through that whole given period, what was it then? If it was lower, we need to continue on because we need to get that number brought back up by June 30th for you to still have that loan forgiveness. If it was equal or above, well, you're looking good. You didn't lose anybody, you didn't drop anybody. So then, which is basically what step 3 is kind of saying, then we need to calculate what our FTE is on June 30th. So that's the magic date. And there's another question in regards to this, that if you If you didn't get funded by May 5th, your 8-week period will actually end after June 30th. So that's something really important to pay attention to. That means if you just are getting your money, you may have to do this, have everybody back still by June 30th, even though you haven't used up your whole 8 weeks. And the final point there is, of course, that as soon as you've calculated what it's at June 30th, if that number at June 30th is equal or higher than it was on February 15th, you have met the requirements for safe harbor and you're a happy person and good to go. Safe harbor means loan forgiveness is looking great for you, basically. Anything to add to that part? Otherwise, we've got the fun exceptions aspect.
No, I mean, I will just point out that it is really interesting in that safe harbor that the date range they use for that is February 15th through April 26th. So the average of February 15th through April 26th compared to February 15th, right? So if you increased employees between February 15th and April 26th, then this is going to be a little weird on this calculation, right? Just to be honest here, right? So know that there is some strange pieces to that and be aware of that.
Thank you. And before I jump to this next part, I just want to reiterate to everybody, because I'm trying to run the slides at the same time, we're not jumping into the questions yet, but please keep them coming in. I do promise we're going to go through all of them right when we're done with this. We're getting pretty close through the info. So thank you for asking the questions. We will follow back up on those. So now what we're talking about at this part, the FTE reduction exemptions. This is that newer portion of it that if, bottom line, if you're in California, if you're making less than $25 an hour, you're bound to have some employees that when you say it's time, hey guys, time to go back to work, we've got you ready, they're going to say, yeah, that's okay. I'm having a great time on unemployment, making more money, not doing anything. So they recognize they needed to have a way to try to protect the business owners from that as well. So there's a couple requirements to it. Basically, any positions for which a borrower made a good faith written offer to rehire an employee during the covered period or the alternate payroll covered period, which was rejected by the employee, and any employees who during the covered period and blah, 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 were fired for cause, that's important, fired for cause, voluntarily resigned or voluntarily requested and received a reduction of their hours. You have to track this, but you will have an FTE reduction exemption basically to your numbers the way this works. What that means basically is, so this under safe harbor, what this would do is the borrower is exempt for the reduction in loan forgiveness based on FTE employees. So what this, like we were talking about before, this is based off of not only FTE count, but then you still have that money question that's out there. This is only taking care of that FTE count number. That's all. We expect we'll see some more guidance on this as the days come on, right, Jacob?
Yes, I'm expecting to see a chunk more guidance on this. Some simple things like, obviously, since for the safe harbor standpoint, we're looking at FTEs February 15th to April 26th. But if the reduction exemption didn't happen during that period, does it actually count in the safe harbor or does it not? We know it counts for, which we'll get into later, what is table 1. We know it counts there. Does it actually count for the safe harbor reductions step 1? There's some gray areas there for sure. On how that actually applies to that and the safe harbor calculation itself. Like, I feel like we understand how it applies to the application, but maybe not the safe harbor exactly, because they haven't laid that out all the way.
Yes. So what we have here now is we've got screenshots of the important parts of the different, application or calculator, however you want to call it. This is the primary, the schedule. Sorry, this is the primary calculator form. You're going to have information, of course, like your SBA PPP loan number, your lender loan number, the loan amount. It's going to ask you for the number of employees at the time of the application, as well as the number of employees at the forgiveness time of forgiveness application, this one here. You have to know your EIDL amount you received, the account number. This is where it's gonna first ask you about your different pay schedules also, whether it's weekly, biweekly, so forth. And it's gonna ask you for covered versus alternative periods as well. Now, what we did is I actually created a mock-up example where we're using this and filling it in so we can kind of walk through the whole process and hopefully help connect the dots of what's going where and why. Of course, the 11-page document does have pretty good information as to what's supposed to go where. That helps, but this will still help some more. Now, the Schedule A is what works pretty heavily off of, there's 2 tables of information that would need to be filled in. And they are in a PDF, but you'll end up making them again in Excel because most people have more than 6 employees, most likely. So the sections of this are broken out, of course, to first your cash compensations. For line 1, it's looking at your average FTE count. And then below that is now where you have for those salary, hourly wage reductions and calculating that information. I'll show you the table and we'll go into that. So I'm going to bounce back and forth on some of these parts. Table 1, the thing that's the most important to pay attention to is this is where you list employees who received compensation at an annualized rate less than $100,000 for all pay periods in 2019. So the entire year they made less than $100,000. You would also list any employees who were not employed at any point in time in 2019 as well.
And so also remember, compensation is considered cash compensation. So add backs should not be considered for this.
Which is why we brought, we tried to add that in previously as well. So now this information that you're seeing here, this goes directly into that. It's the purpose of these first 3 right away. So the worksheet will then populate into these. The next table, I'm going to actually explain the next table and I'll bounce back to these real quick. But the next table, what's different here, and Jacob, I want to get your input on this also. This is for employees who received compensation at any annualized rate that exceeds $100,000 for any pay period in 2019. So Jacob, my question that I don't know for sure, if it's any pay period and you're doing it as an annualized rate, does that mean if you have like a $8,000 pay period, you would annualize that and be above it?
I'm going to assume that they're going to use W-2 numbers here. So I'm going to assume that no, they are not diving in. And I'm saying that because also if you look at what they're requesting that you give to the borrower, they wouldn't have that level of detail for 2019 to be able to pull that out. That's my interpretation. Once again here, super clear. My interpretation is not what it actually says. If you notice the top section says, let's say you go to $100,000 for all pay periods. This down here says any pay periods, which would mean if they weren't both all, you could end up with somebody on both or somebody on neither.
Good point. Okay.
So I feel like they're going to be consistent between the two. And I think it's just a wording change that'll get changed on that table 2 section.
So,
and the thought process behind that is there is no salary reduction for anybody who makes over $100,000. So if you had an employee that got paid $101,000 and you reduce them to 50, there's actually no salary hourly wage reduction calculation on that for people who were over 100K in the prior year. So I don't think it is. I think it's going to be all pay periods, and it's just a wording difference.
It's a very good point. That's actually makes a lot of sense. And it does, of course, give guidance. So cash compensation, we know it can't be more than the $15,385 on either one of the tables. You just touched base onto that as well. And then your average FTE would go into here as well. Loan forgiveness amount the borrower will receive may be less if the average weekly number of FTE employees was less than the borrower's chosen reference period. Chosen reference period. This is where that first comes back into play again. So that's, your February 15th of 2019 to June, or your January, February of 2020, either one. Salary wage reduction. So this again would be the amount of loan forgiveness would be reduced if whether the salary or hourly wages, and that's a key thing, of certain employees was less than during the period from January 1, 2020 to March 31st, 2020. This is the first one, right, Jacob, that all of a sudden changes the period of time and does this January 1st through March 31st time.
And this does go back to the bill where it said, let's compare it to the prior quarter. So it is comparing to that prior quarter, but it is strange that it's the one place we're using a March 31st, 2020 deadline. And I'm sure this will trip some people up as we go through that.
And the other part to pay attention to is it does talk about in here that you use salary for salaried employees and you use the hourly wage for hourly employees.
And that's not hourly earnings. That is their wage rate. So if they make $15 an hour, hourly wage is $15 an hour.
Yep.
And if you dig into this calculation, which I think we dig in a little deeper on the next page, so I don't want to.
We're going to go through basically, and
that's the FTE one. That's the case. Okay, let's step back. I'm going to talk about this a little bit more before we dive into the case study. So when you work through this safe harbor of the salary hourly wage reduction, there is no wage reduction if a $15 an hour person is still making $15 an hour. And this comes into play kind of crazily when you marry the two safe harbors together. Remember when I said before, you had a person working 30 hours and now they're working 10 and they're still equal to 0.5. So there is no FTE reduction.
Okay.
That same person's making $15 an hour.
Still making $15 an hour.
Still making $15 an hour. There is no reduction due to that person, even though that person went from making $450 a week to $150 a week. There is no reduction in this.
So this is an area we expect them to realize that they made a whoopsie and provide some other guidance onto it. Because even the calculation on their form, when you go through it all, it caused me some headaches because it doesn't work that way.
Right. Yeah. But when you actually work through their calculation, that is true, right? So I'm being stupid here. Please don't go try this, but based upon that knowledge, it's like we're gonna host a company party on 6:30 and everybody that was laid off comes in and works. They get paid because it's paid, not works. It's paid hours. They get paid for the company party of 1 hour. And now they were all back at the same rate they were before or higher, because if they were a server, we're bringing them back a minimum wage because they don't have tips.
Yep.
So we've increased it. Wage rate's still the same. Full-time equivalent still 0.5 for each of them. No reduction. I feel like that should not be there. And that's why I'm saying do not try that, because I feel like there's going to be a problem with it and it'll change. But as the calculation stands today and the true interpretation of it, that would actually qualify and you would meet both safe harbors. Just thought I'd put that out there of where I'm kind of expecting some change here and where there's not clear guidance.
Yeah, it's, again, that goes back to the idea of where we've seen the most of our clients asking questions, and it's all focused around, well, what if I don't bring people in right away and we don't spend that money necessarily right away, but we bring them in before the last minute? Can I then use those extra funds that I have to spend also towards a bonus for myself? Or
so I'm actually we don't have this slide, but I want to bring up one other thing on that safe harbor for salary and wages. So on step one, which is, do you proceed to or not, right? Like if somebody had a greater than 25% reduction, right?
Yeah.
Then obviously you go to step two and they're going to look at truly the hourly rate, if you brought it back up or not at 6:30. There is a interesting thing in here for annual people where initially you're comparing the average annual from January 1 through March 31, right? In the second step, though, you're comparing the average hourly rate on February 15th, 2020 to the average on February 15th, 2020 to April 26th, 2020. So if you gave somebody a raise during February 15th to April 26th, then you actually have to drop down and look at what you actually, if you didn't give, you gave them a raise in salary or hourly rate, you have to go down and you actually have to calculate what you actually paid them in the comparison. So if you gave them a raise and then laid them off, you may run into some hurdles with this safe harbor calculation.
Okay.
Just putting this out there, like there's some weird things in here.
Let's
I'm
take a
putting
look at
this
that when we
here.
get through the forms and it'll
Yeah.
kind of
Yeah.
pop
So
out.
I'm not wanting to, I'm putting this out there to just make people aware. These are safe harbors, but they have pitfalls in them.
There's a
And
lot of
don't
ways.
just assume everybody's back and we readjusted their rates back down. We reduced the hazard pay. They're where they were before. We're good. It might not be that simple.
All right. So here's a fake company called Spot On Distributions. And in 2020, Spot On Distributions employed 5 people, not including the business owner. The business had very little employee turnover and takes pride that their entire team has been working together for the past 4 years. Due to COVID-19 pandemic, the company was ordered to close all operations. The company just received their PPP funds and wants to know how much of the loan will be forgiven. So trying to put together a case study concept, and I actually plan to try to build up more of these or be able to do more examples of how they get pretty nitty gritty on things, because this is the stuff I feel we actually all really, really need. Out of the information that was provided, I did a couple things on purpose. By saying they were all there for 4 years, we simplified this by saying everybody's been hired on. So whatever kind of covered period you were doing, those were all like, it's all even, Steven, all that kind of stuff, right? Then we have the employees here. So we've got Greg C., who is actually supposed to be changed to a manager, but so pretend it says that there earns $1,500 salary each week for his 55 hours. Linda A. works 50 hours per week at $20 per hour. Seth D. earns $15 per hour and is scheduled for 35 hours per week. Mary works 30 hours per week for $15 an hour, and Jacob is paid a big, huge $12 per hour, but only works for 20 hours each week. Now, this scenario with these employees would give us the ability to run quite a few different versions of how you would do that whole FTE count and what would be necessary or not. The biggest one, of course, again, in California, I always go to, since it's where we're at, we would always consider 30 hours before is what FTE is. That's not what it is. It's 40 hours. 40 hours is your FTE. Additional information we need to know about this, of course, is what were the pay cycles like, right? Because we want to be able to figure out, should we be going with that alternative pay period or pay cycle, or do we want to go from the covered period instead? We also need to know when they got funded with the PPP, because that would help us define both of those, the covered period versus the alternative covered period, as you can see down at the below here. Now, the 2 choices for chosen reference period, just as a reminder to people, would either be your February 15th, 2019 through June 30th, 2019, or you could do January 1st, 2020 through February 29th, 2020. That all makes sense so far, Jacob?
Yep.
Cool. Then the amount funded we got, $46,818.25. I did a extra slide in the appendix to show people because I figured they would ask how that was done. So what I did is I basically tried to go through and I turned this into a calculator that I'm willing to share with people, of course. You know, PDF calculators can be a little funny sometimes, but people are welcome to use it if they'd like. We filled in the information hoping that it would be able to tie everything back as the whole goal. So as you can see, we've got our loan amount that was in here, our employee at the time of the loan application. So if I step back, let's talk about that list real quick here. We've got Greg is a salaried employee, right? He's 1. Linda is at 50 hours, but the cap is at 40. That's a solid 1, no problem. So now we have the 3 remaining people. They're all underneath 40 hours. So by combining them together, it becomes 1.5 at the most, right? So because we would take, I should explain that better, I apologize. We would have our 30 and 35, right, Jacob?
Correct.
So if I do 30, 20 is 50, that puts us actually at 85 hours. So this would actually be 2 people.
Yeah, so it's 2 people under the SBA recommended calculation, right?
Yep.
So we have 4 people with the SBA recommendation. or we have 3.5 at the simplified method.
Thank you. So that's a great
because
example.
You have 0.5, 0.5, 0.5.
Yep.
So
perfect. So that is a great demonstration of how it could work either direction here. So based on what we did there on the simple version, 3.5, our covered periods we wrote in, alternative covered periods, we added the details in as well. And I did this also on purpose, and I want to draw attention. This is kind of silly, but if the alternative payroll covered period, if you're dealing with anything that was actually, like if they just got funded right 5/9 or so, something like that, 5/10, it's going to run into 4th of July weekend, guys. So pay attention for banks and what is necessary right around that time to make sure you're paying out whatever you need to pay out.
And just to be honest too, we also don't know what that looks like after 6/30 right now. So just be aware of it. Obviously, we're looking for additional guidance on that, but that so also may, if you know the staff's going to be off over July 4th, despite whether 6/30 matters or not, it may be more advantageous to take your other, because you can incur what was actually spent, what was actually done. We know we can get more weeks in there anyways based upon that. It may not be worth dealing with them being shut down over 4th of July weekend and not having hours.
Yeah. So to touch base actually real quickly on covered period versus the alternative payroll covered period. When we did this, the reason I put the normal pay cycles here, April 26th through May 9th, I did that on purpose because we said if the PPP funded May 4th, the way the alternative covered period works, it's the first day on the next pay cycle. Okay. So that's why that one would have started May 10th instead of May 4th when the money hit the bank. Something to keep in mind. Now, as we go through, of course, I'm blocking the top portion of this one. This is so the 34,600 is based off of the very first table that's having you go through and calculate the cash compensation for all of the different people listed. Okay, I made this one simple to the idea that we didn't add anything extra at the moment for mortgage, rent, or utilities, just so that becomes the easier stuff to calculate, but the payroll aspect of it, I want people to be able to recognize. So we've got zeros with that. Then you've got your adjustments for full-time equivalent and salary hourly wage reductions. So some of this stuff, it's all populated through the extra work that you continue to do. So we're going to go back to this in just a moment, because first we have to take a look at the different tables as to, again, the cash compensation. We would go and add all of that stuff in, gave us our 33,400. And based off of the structure we were doing and following along the same time, we had an FTE count of 3.5 off of this. So we literally are putting it in as each person a 0.5 or a 1, a 0.5 or a 1, a 0.5 or a 1 the whole time. We, again, simplifying this one here, we didn't have a salary reduction in this example because we brought everybody back at the exact same amount of pay, same amount of salary. So there was nothing, like it was dollar for dollar exactly the same. The calculator, if you were to play with it a bit, you could change and play with that around to, I'll create some more examples like this where we can show that. But if you did have that reduction, you'd have to calculate that out to make sure the reduction was no more than 25%. Otherwise, you would lose the safe harbor on that aspect.
And since you have that, Matthew, you didn't check it here, but there's actually a box to check in line 3. If you look there on line 3, there's a little box to check toward the end.
Correct.
That you can check and drop the 0 in there.
Yeah, exactly right. I actually went through the next part at the bottom does the same thing, but I wanted to show the steps. There are some areas where you can check the box and you don't have to do the calculations.
Yeah, but obviously if you want to see the calculations, you need them there.
So then in here, basically we've got, we've gone through if we were doing table 2. So this was table 1, the one we had at first. Table 2 is, as a reminder, is the one for anybody that's, if they're earning more than $100,000 per year. Table 1 was if it was less than 100,000, or as well as if they were not employed during 2019. Same kind of concept. What this does do is it does ask us to break out for the employer health insurance, employer retirement plans, separate line items for those. Again, to make it simple at first, we left those off, but line 8, of course, you're going to have your employer's taxes would populate into there as well. Compensation to owners. Again, same situation that this one is. So total amount paid to owners, owner-employed, self-employed individuals, and general partners. This amount may not be included in PPP Schedule A worksheet 1 or 2. If there is more than one individual included, attach a separate table that lists the names and payments to each. So this is kind of their answer to that, right, Jacob, where they're trying to pull that stuff back in?
Correct. Yes.
And then that basically what happens there is it's adding all this stuff together. So it's going to take 1, 4, 6, 7, 8, and 9. And that calculates and gives us the total amount of 34,600 that we have. So that's our total payroll cost for the whole period of time. Then the last thing it's asking us to do is we're doing that review of our FTE equivalent. So Jacob, this is where you mentioned this earlier, the idea that on how you go through for your safe harbor, I've got it basically right here, that if the safe harbor timeline is between February 15th and April 26th, if your FTE number is larger on February 25th than the average amount of the 15th through the 26th, you will still need to increase your FTE count before June 30th to avoid reducing your possible forgiveness. If it's equal or above, you're good for that portion of it. The next test becomes June 30th. Even if you fulfill the first part, you still by June 30th must have equal or greater than the number that you had on that February 15th. If you do, safe harbor has been satisfied. Did I say that correctly, would you say?
I believe so.
Okay.
I'm saying I believe so here because
we don't really know for sure.
This one, I feel like there's going to be some interpretation on.
Okay. And then as a reminder, for alternative covered periods is only used for the payroll expenses. Covered period is used for non-payroll expenses. You can use, for payroll expenses, you can use either one, I should say. For non-payroll expenses, you only use the covered period. So now we dive into additional questions, and we've got quite a few there. So anything you want to add on initially here?
No, just besides, once again, there's a number of things here that we know we need some additional guidance for. There's a number of questions outstanding, so we will not be able to answer everything for sure, right? But I'll be honest and tell you where we don't feel comfortable answering, where we don't. I'm not going to give you an answer that we don't know. I'm not afraid to say we don't know that yet. So if we don't answer your question specifically, it may mean that either we don't have guidance on it, we'll say that, or if you ask a super analytical question, some of these calculations are going to take hours upon hours to figure out. The SBA's expectation here is 3 hours per application. I think on some, if you do 100 of these, you might be down to 3 hours on the simple ones. On the not so simple ones, you're going to be much longer than that still.
Yeah. All right. So I have on our side, I've got my little PDF calculator in case for some reason we need to try to play with that, manipulate to answer questions. But if you want to pull the questions on your side as well, and we can kind of go through them. Again, thank you everybody who jumped in to watch this. We really, really hope this has been helpful. This stuff is a lot to try to digest all at once. So hopefully this will get everybody started off on a good week, having at least some more insight ahead of time.
Your biggest question is everybody wants your slide deck.
I am working on one that I can be able to give out to everybody. I am expanding on this one so I can try to motivate one of the bigger companies to do webinars with me on it, if that makes sense, people. So, but I'll work together with it. So, do you have any you want to tackle first, Jacob? Otherwise, we can start at the top and go straight through.
Go for it.
Okay. All right. Let's see here. A few questions I didn't email in. How would you account for employees on medical leave?
So, are you talking the Family First Coronavirus Act,
Good question.
Medical leave or not? So if you're on the Family First Coronavirus Act, they still get counted as a full-time equivalent. the pay you pay them does not get counted as wages.
And that's because they get that money, they get a dollar for dollar tax credit
Correct.
on that is why. So
interestingly enough, right now, nothing in the salary and age reduction piece covers that at all in their current guidance. But you have to believe that if we can't include that compensation up for the compensation side, it shouldn't be used in the wage reduction calculation. Although it's not listed specifically, we expect, once again, some additional guidance to come on that. But I'm going to be very clear. Right now, you cannot include it in your forgiveness expense. And per the letter right now, you don't actually get to exclude it from your comparison, which means those people would be short wages, which would reduce your forgiveness by the letter. I don't believe that's correct. I feel they're going to come out and correct that and say if someone's on, Family First Coronavirus Response Act, medical leave, that they're exempt from the hours and wage calculation.
Okay. It's a great question. I mean, the only thing I think of through that is if you're required to hold a job for somebody until they come back, like,
Correct.
How does that work, right? So
Correct.
It's a good question. So let's see here. Can we still do an extra payroll on the last day of the covered period? What do you mean by extra payroll? I would question that because we've got the idea of the incurred versus the cost of payroll. So
you could, you could still do an extra payroll on the last day if you wanted to, but there is now not a need to because you can record what's incurred anyways. So there is no need to do that extra payroll. Not saying you can't. I'm not going to say your bank might not love you if you do that, because talking to a banker and helping them understand accrued payroll and what is the correct accrual calculation will be fun. But you do not have a requirement to do that extra payroll to get that spend inside that period now.
Good questions. Okay, so I'm going to skip down to some others and then I'll come back for some from more of yours, Kathy. So Karen Schwartz was asking for solo, is health insurance considered covered? That's a big question we've been asking.
This is a big unknown. There's some mixed language in this bill because, interestingly enough, it breaks out owners, employees elsewhere. It does not mention owner employees in this section at all, one way or the other. It is listed before the owner employee wages. Typically, I would say from a tax perspective, no, because it's not deducted upon the Schedule C. Same thing for a partnership. It's not deducted on the partnership tax return. It's actually deducted on the 1040 itself, not on the Schedule C. But we've seen the tax rules don't apply in these cases. And the supporting document they're asking for your health insurance is actually the statement of your health insurance, which would lead me to believe if they're just going off the statement and no employee or payroll records, that it's there. Now, statement many times doesn't break out employee versus employer, so I don't know that that's going to be adequate for the bank. Once again, a lot of gray area around this. I am not comfortable answering one way or the other on that, and we need to wait for additional guidance on those health insurance, especially for Schedule C and partnerships. I do expect right now there to be some consistency. They're showing that they want consistency between an S Corp and self-employed employees. That's kind of why they created this new owner employee designation. So despite the fact that Schedule C and partnerships are not deductible inside the business tax portion, right, on the Schedule C or the partnership itself, and an S Corp is, even though there's an add back there. So actually it's not because of the add back, but I'm guessing they're going to treat them all consistently from that standpoint. Which way? Unknown.
All right, so I'm going to jump over real quickly. I'm going to do Zoom and the other ones real quick here. So looks like on YouTube we're good, but Norm, you can definitely ask questions. Be happy to answer questions for you. Norm McDonald, that'd be great. Let's see here. In Facebook, it looks like we've got, let's see here, tech challenges. I'll come back to those. So our questions in Zoom. We've got, okay, so this is kind of, if payroll, if it was funded, payroll, if we funded May 8th, check date was May 8th, but the ACH came out on May 6th, can we count the payroll?
So it actually specifically dives into the ACH, and it is on the date the ACH is initiated. So if it's a paycheck, it's on the date the paycheck is issued.
Yep.
If it's on an ACH, it's the date the ACH is initiated.
That's a good point.
So when did you actually initiate it, right? The flip side of this is as well, remember, if for payroll, once again, if it was incurred, it's definitely deductible. So this is more of a question on the front end. Oh, I ran payroll on Thursday. They actually got direct deposited on Friday. I got funded on
Wednesday.
Thursday.
Yeah.
Do I get to count that pay or not because it paid on Friday, or not because the ACH was initiated on Thursday?
It's incurred at that point, right? Is the thought.
So
it specifically talks about the end, but it doesn't talk about the beginning is the challenge.
Correct. So I think that beginning is a challenge.
Okay. And is there a calculation for retirement benefits that can be used as a plug if needed to get to the 75% threshold?
What did you pay or incur? So for owners, they like do a SEP contribution on an annual basis. Typically, if I were here, I would be incurring that and paying it during this time. Because since you don't typically pay it during this time, but it is incurred over the whole annual wages, I think we need to look at doing some SEP contributions in real time instead of afterward during this time. Otherwise, I'm not sure how you get there to handle that side. That's a big one, right? Like, we're looking at the retirement side and saying, how do you handle that? Exactly.
I think with a lot of these things,
incur forever either, because in the incurred, it does say, it says something about the payment schedule. So I think if you were waiting until February of the next year to make that SEP payment, it's not going to qualify, even though you're saying it's incurred. There's going to have to be some reasonable timing on that. And to get the proof of it, they're asking you to submit payment receipts, cancel checks, or account statements documenting the amount of any employer contributions to employee health insurance and retirement plans. So you're going to have to submit those cancel checks and things. So you're going to have to make that before your forgiveness calculation's done. So we just need to get a little tighter on that. That being said, you could be funding the max percentage of your SEP during this time, right, on the employer wages. And as far as we know, that may qualify, right?
Yeah. Again, so part of this is going to be trying to go along with the intent of the bill itself. Keep in mind, if you're trying to rub the lines of, legality of this, don't go rub every single one of them. I mean,
well, here's the flip side. If you can pay it anytime during this and incurred it, that's not the decision to make today. That's the one to hold, and you're going to make that decision once guidance comes out. Rubio has said yesterday that there should be more guidance before anybody's 8 weeks is up, and the earliest 8 weeks is up in another 2 weeks. So I'm expecting in this next week there to be a decent chunk of things happening.
Yeah. Okay, so let's see here. So Steve Kenny was asking, said they may be too specific. So let's see here. SM LLC in 2019 that converted to an S Corp in 2020, where the owner began taking payroll. Would it still be based on? Would it still be based on the 2019 Schedule C or by the payroll taken in 2020? What was your answer? And then we'll know if we did it right with what we tried.
So I'm making sure.
In this scenario, they've got the ability that they could literally do their January 1st through February 29th period as the look back period, right?
But remember, owner's compensation is always based upon 2019.
You're right. Okay.
So owner's compensation as of right now is always based upon 2019. So therefore, in my mind, you would have to use the 2019, even though they began taking payroll. The answer we don't have is what happens to a business that started in the middle of 2019, which means their average payroll wouldn't be where it should be, or that started January 1.
Yeah.
You went from a sole proprietorship to a partnership, which requires a new EIN number. So you had a new business as of 1/1. How that's handled, we don't know yet. I think if you're going from a single member LLC to an S Corp, though, your EIN stays in existence as long as you were in business all of 2019. I'm pretty sure that answer is going to be you have to rely upon 2019.
We will, keep an eye out for more information of that, of course. So, see here, a restaurant employer used PPP funds to keep employees on payroll. PPP funded for 6 expires 6/1. Use 75% fund for payroll.
I'm not sure what that question is there. I think that's more
Joey,
of a statement.
if you don't mind, I think I missed the question, or maybe it was probably during our presentation. So if you can add more context, it would help us out. Okay, then Vicky has, what happens if client is funded after 5/5/2020 and the 56 exactly, and after the 56 days. So now the key thing is 6/30. That date is when you have to have your FTE count up at, you have to get your FTE count correct. So what it means as it stands so far is you'd still have to have your FTE count above, and then you could still continue to use the rest of the 8 weeks, the funds for the rest of the 8 weeks, but you may be required to ramp up faster to make sure you still hit that 6/30.
Because your safe harbor and both of your safe harbor calculations are going to be as of 6/30. I think you'll be able to have spend afterward, but you don't have the ability to spend all your money and then increase your counts, right? Or spend money for the 8 weeks. And as long as you increase by 6/30, you're fine.
Yeah.
You're not going to get that option in that case. You're going to have to have those where you need them to be by 6/30.
That's the best plan of attack until we hear anything else. Just plan that.
Right.
For sure.
Could that be changed? Yes. Right. Everything is open to change at this point.
Okay, so this is a very good question, which is going to trigger for you for sure, Jacob. Can an employer accept reduced forgiveness by not formally asking an employee to come back and allowing them to stay on unemployment, and then having them come back on June 30th to avoid reduction based on headcount?
So as long as everyone came back, or you truly offered everyone to come back on June 30th, obviously you didn't spend your money.
Do it before June 30th. Do it like a week before.
But of what you spent, as long as everyone came back, or you have a written effort of trying and they didn't come back on June 30th, then your headcount equivalent should not impact your forgiveness amount as it stands today. This goes back to that crazy example I gave of, before we had 10 people working, at $10 an hour working 30, and now we have 10 people at $10 an hour working 1, and we have no impact to our forgiveness of what we actually spent.
Yeah, there's again, Safe Harbor has some questions onto it. A big part of this is going to be having those offers in writing. I've got when we're done with the questions, I was going to show a quick template email or letter that we create that you can use for employees too. Were you going to say something, Jacob?
Nope.
Okay. John, let's see here. Interesting that the word gas is used in utility sections. I wonder if they would accept heating oil. Any thoughts on dental insurance? If it's part of medical, what do you think?
So,
they're broken out separate though.
So gas, clearly in utilities, gas from natural gas or heating gas is always included there.
Okay.
The interesting thing in the utility section is actually the transportation word, which in one of the IFRs says gas for your vehicles. Because in utilities, I don't see gas as interesting because we always include natural gas, propane, heating oil. Your heating utility is clearly that. because a lot of people heat with electric as well. So that makes a lot of sense. The transportation section of that is a lot more interesting to me because we're not sure what all qualifies as transportation. In one of the IFRs for the sole props, IFR from 414, it says gas for your vehicle under the sole props. Does that mean true gas receipts? Does that mean mileage? What does that mean? What's all included in transportation? We have not seen any guidance on that yet.
So Joy put back in more information. So restaurant employer used PPP funds to pay employees funded 4/6. 8 weeks ended 6/1. 4/26, all employees were on payroll. Will employer be negatively affected if shutdown continues? And MI, I think, is for Michigan. And
Michigan.
Employees are actually laid off on 6/30. So
because I think Michigan just extended their stay-at-home order till July something. So this is a real concern for them, and I get it, right? So if your employees are still laid off on 6/30, your full-time equivalent calculation is not going to work, right? Like, so your ratio on full-time equivalents, if you had 20 people before and you have 0 employed now, or if you only have the 2 owners employed, right? So you have 10% employed, you're only gonna get, let's use that example, you're gonna get 10% of what you spent forgiven. And remember, what you spent before you actually apply that, you have to do the 75% on payroll, 25% on other things. So if you spent this to pay the owners and you spend it on rent and utilities, you're not going to get all that rent and utilities done to start with, because that's going to be limited 75, 25%. And then after you do the 75, 25% limits, you're then going to only say, I get 10% of that number forgiven on that. So this is a big concern. And, you know, this is the reason in the HEROES Act, they had this changing from 8 weeks to 24 weeks. This is why Rubio has came out and said, we have to fix the 8-week thing. He's put that in a tweet yesterday. They realize the 8 weeks is not going to work if you're continuing to be shut down. Yeah. And they're trying to figure out how to make that work. And it's a weird situation, because remember, this is a payment protection program, not small business bailout. So the goal in this was that you kept people off unemployment. And if you're not doing that, then you're not meeting the terms of the bill, but also they don't want to punish these people. So they're actually in a really interesting place. And I think that's why they're struggling to come up with a solution, because the correct solution under the very original intent was, if you're not bringing people back, you need to pay the money back. Yeah. But they're saying people are still hurting really bad, and this is still ongoing. So these people need this money to reopen and to bring people off payroll when they're able to. So we don't want to punish them now. But how do you blend those two competing intents?
So real quickly,
Sorry, Joy, not a great answer for you, but
a real one though.
It's a real one.
So we're at 7:13 right now, and Jacob, I want to make sure that you're okay with, at least, can you go like another 15 minutes where we can try to answer some more questions?
Another 15 minutes.
And so everybody, we want to be respectful of time and just make sure we will keep going and doing a little bit longer with this record, so we can make this available to people as well, going forward as well. But thank you again. So, all right. So another question was, from Karen was, are they able to hire are they available to hire to help with filing in the form and calculations? So I think are you asking, are we allowed to get paid to do this stuff finally? I think it's the...
Or are they asking, are you and I available to consult? I think Matthew and I would both consult on this potentially. Obviously our clients come first in this, but we're always willing to at least look at that and try to help you out and schedule time to do some of that. I think we can both say that. Obviously we each own our own companies, but feel free to reach out to either one of us. And if we can't take it on, we'll definitely pull on the other one as well.
Yep. Together we all succeed. It's what we always say. So, okay. So going through, we've got, let's see here, bonus in excess of 100,000 annualized would not put in play over 100,000 if their annual was less than 100,000. Bonus is still cash compensation, right?
Correct. So I would say, remember, for annualized, they're going to look at the total 8-week period. and they're going to annualize that 8-week period. They're not going to do it by pay period, which we originally talked about. So they're looking at the whole 8 weeks. So as long as that 8 weeks is underneath the 15,853, that might not be the exact number. I might have had my memory wrong on exact. Then you're going to be fine from the forgiveness standpoint. If you're talking about 2019, I think as long as the total year is not over $100,000 for the year, you're going to be able to get the 15,853 or whatever. 15,384. I had some numbers mixed up there.
So in line with this as well, to some extent, is can you give employees an advance on their holiday bonus during the 56 days in order to reach the 75% if needed?
So is their holiday bonus actually part of their compensation plan? And if not, why are you calling it a holiday bonus? Why aren't you just giving them a bonus?
Which holiday?
Yeah. So
hazard pay, right?
You can do a bonus during this time. Calling it an advance on their holiday bonus will not be acceptable. I'm just going to say that, right? You cannot pay them compensation that should be being paid in Christmas for now. But being a good employer and giving them a bonus now. Now, if you decide come December, you don't have as much money and you're not going to give them as big a holiday bonus, that's on you as an employer. But paying them a bonus right now does not cause an issue. But do not try to give anybody an advance during this time and take that as compensation paid for the current time, because it would not be incurred during this time. So you can't do prepayments. It's very clear when they get into rent, utilities, you cannot do prepayments. So as long as it's a bonus for during this time and not a prepayment, you should be fine.
Okay, so we've got some other questions Linda's been feeding in from Facebook, but I'm going to postpone on them because I don't know that we have good answers specific for the self-employed aspect.
I'm going to grab a couple that are in the Zoom.
Oh, go for it.
There's a question here. If pay period is semi-monthly, can we choose alternative pay, covered period? No. You can only do that for weekly and bi-weekly pays.
Bi-weekly or greater.
Yes. Yeah. The Excel spreadsheets for this info, I am working on one. My guess is we won't have it completely finalized until the end of the week or so. We are updating the tracker that I put together for a lot of time because we kind of dove into this today, a couple of us, and the tracker is still by far the best way that we can find to look at it as a glance and track it by week. Really, to do this application, you have to do it by employee. So the amount of manual rekeying just doesn't make sense. It makes sense to have it for the end of this when you're actually going to submit your forgiveness and just grabbing numbers from your payroll provider. It doesn't too much make sense on a weekly basis to try to be entering that much data. Just pull those numbers. We'll use the tracker sheet. So we're kind of building a hybrid system. At least that's our method. I'm sure other people are going to have other methods.
Well, in alignment with that, everybody that's watching this, if you can actually do us a favor, please, in the comments, let us know who are you using for payroll. And the reason for that is if we know that there's a majority of everybody's doing it a certain way, it may be easier for a add-on template where you can download a certain report and have it quicker to populate into something. So please let us know who you're using payroll with, and maybe that can help out. What else you got?
There's one in here, as consultants, how much flat fee did you charge? I'm assuming you mean to your clients. I am just going to be blunt, and I've talked to a lot of other people. I'm not flat feeing or value pricing this. I don't know that you can, because there's so many variants here that are unknown still on the front end, especially if you're pricing right now. And how many times is it going to change? The other thing is the value is kind of, if someone got a $500,000 loan, what's the value for getting it forgiven? Can you really justify charging them $40,000 right now? Because that's really probably what the value is of it. So a lot of this we're dropping to hourly. What your hourly rate should be would be based upon your knowledge, right? That's not one that I'll all tackle, right? So you have to charge that hourly rate you feel comfortable with and your size of client's going to be okay with, right? Because the person who got a $2,000 loan probably is not comfortable paying the same hourly rate as the person that got $1 million one.
A quick tip for anybody that's a small business owner that's watching this. One of the best things you can do right now, your accountants, bookkeepers, tax professionals, be nice to them. Understand if they're getting back to you slow. Like I will be 100% honest. We've been slammed over the last week and a half, 2 weeks. I am so far behind on emails and I feel bad on it. So just give us a little extra breathing space as we're trying to do the best we can for you on it too.
And if you have a monthly agreement, don't expect this to be included in your monthly agreement. This is very far out of scope from what your monthly agreement is. And this is a massive amount of work.
I mean, Jacob, I know that you've probably got well over 100 hours just researching.
Yeah. I'm guessing I'm climbing up on the 200 hours of research at this point.
Yeah.
And building tools, building articles, those type of things.
So question about Safe Harbor. Fast iteration of that again, and then trying to be respectful time-wise. I should be able to actually get all of these questions and be able to follow back up. And, you can reach out directly. We can try to get you more information as best possible. But do you want to do a quick reiteration of Safe Harbor and what that means and looks like?
Which Safe Harbor?
Whichever is the safest harbor. No.
So, when you talk about Safe Harbor, there's two Safe Harbors. There is full-time equivalent one, and there's the wage one.
Yes.
So let's just dive in first to the full-time equivalent one, right?
Which is back here.
It's actually on the bottom of worksheet. It's on the bottom of the worksheet.
You can keep talking. I'll find it one of these days.
So this one, we're basically looking, was your full-time equivalent count? I'm going to keep this really simple. On 215, the same or less than it is on 630, right? If it's same or less, we're good, right? That is where simple as that gets. There is a weird exclusion that if you increase from February 15th to April 26th, this may not work for you, right? If you increase your count and then
drop back down.
Yeah. So that is the full-time equivalent one. Okay. Wage Safe Harbor. Simplest thing. 2 steps to it. One, is your average during the cover period more than 25% less than the first quarter average, which is January through March, right? If you're if you're 75% or above that, automatic Safe Harbor, right? If you're less than 75%, the next Safe Harbor is the salary or hourly wage rate on 630 greater than that of 215? There is one exclusion in here. If the average rate from 215 to 426 is greater than 215, back to the other thing again, right? That section of if you raise people's rate, this could become an issue once again. So I'm going to keep going there and talk. I'm going to skim some questions and see.
Okay. And where those numbers come into play also has to do, so it's this last section on page 6 where you're going through, and if you're fine, you check off the box as you would see here. Otherwise, you've got your line 11 is your initial FTE. Then you do your comparison basically, and if you've met your Safe Harbor, so you divide this by this becomes 1.0. That's basically how that would work.
So, yeah.
What else you got?
So I'm going to go rapid fire here, right?
Do it.
Will owners count as FTEs? No, they don't count as an FTE in there. They're not there.
It's good to know.
Employee education payments. I don't believe that's considered cash compensation, so therefore I don't think that would be included in this. I haven't researched that completely yet, so it is one thing that needs to be looked at. If it can be looked at as cash compensation but non-taxable, then maybe it could be, but since it's non-taxable, I'm going to say no. Then we already answered that one. We do need to be consistent on simplified method versus full business SBA method of full-time equivalent calculation. So know that that has to be consistent. That one we already answered. We are available to do consulting if you need it. EIDL advances. So you have to give the SBA the amount of your EIDL advance on the form. The form does not actually factor that into the calculation at all, but the SBA is going to reduce your forgiveness amount by the EIDL advance when they receive your form. So you submit $50,000 of forgiveness, SBA gets it, they reduce it by your EIDL advance, they tell the bank, here's what you're going to forgive.
So I want to clarify that because there's been a lot of questions on that. Let's say that same person, they got $5,000 in EIDL advance. Okay. Explain. So when you're saying they're going to reduce it, $50,000 PPP, right? That means, and let's make it easy that everything else was 100% going to be forgiven somehow magically before that. That means when it's all said and done, they still owe $5,000 for that EIDL advance. Is that correct?
Correct.
And it's at the 1% for 2 years because it's
Correct.
rolled into that at that point in time.
Yes.
Okay. The only way the EIDL became a grant is if you are denied a PPP loan, correct? That would be the only way it became a grant, I believe.
Correct. Yes. If you didn't get a PPP loan, that's the way it becomes a true grant. Okay, some other ones here. Question about what can a client do if they paid employees for April even though no one worked? It does not matter if somebody worked or not from a full-time equivalent calculation. So full-time equivalent is based upon hours paid, not upon hours worked. So understand that it's hours paid, not hours worked.
Little side note on that, on my YouTube channel, we actually just did a webinar with AP Indigo for workers' comp. There's special comp class codes. If you're paying people to stay at home and not do any work, you can get your remuneration rate down to 0 with class code 0012. Check in your state if they have it.
So I'm just trying to go rapid fire here, trying to get through some of this, right? So if you don't bring back staff at all and only pay owners, as it stands right now, since owners are not in the full-time equivalent calculation, your full-time equivalent calculation we calculate to 0%, which means your forgiveness would be 0. Kind of crazy to me, but owners are not included in there. So if you only had the owners and one employee, and the one employee you don't even try to call back, you're at 0. Nothing's forgiven. Now, do know that if you try to rehire them, then they become an FTE exemption or exclusion. Sorry, have to not use the word exemption, exclusion, and they can come back, right? So know that side there. There was a question on here about changing payroll periods. You can change payroll periods. I don't see anything stopping you from changing payroll periods anywhere in this, from semi-monthly to biweekly. Now, I will say if you're trying to do that so you can pick an alternative payroll period, my guess is if you're already funded, it's too late to be able to make that happen.
It'll be tough. You
just to pick an alternative payroll period. You may be able to get it through, but I'm not promising anything on that.
This is a letter I'm showing right now that's something we created that we sent out to all of our clients basically, because we adjusted, this was our opinion of how to try to do it before we knew everything. We adjusted people's payroll periods to a weekly payroll where the new pay period started the day that they got funded, because we didn't know what we were going to have with Accrued and everything else. But there's a part of this, the reason I'm showing it more than anything else is the impacts on unemployment. We soft step into this also to the concept is they can give this to their employees, the fact that, hey, you're going to have this new pay cycle. We want you to know about it so it doesn't affect overtime, that kind of thing. But also when you're told you need to come back to work, if you choose not to come back to work and to stay on unemployment, when you choose not to come back, your unemployment stops. It can be stopped. So it's very important that they know that, and that they could be responsible for paying that money back also. And that has to do with that safe harbor exemption concept of it. So happy to make that available to people if they want that.
So I do see several questions asking about SEPs. So self-employed pension plans for the owners of S Corps. As of right now, I believe that can be included. You can actually include the 2019 since that would be paid during this time as long as you pay it, plus what would be incurred. Now, there's some gray area in here where they ask for employees and they don't call out owner employees either way, right? So while right now I think they might be able to be included, there's also a chance that they say, oh, owner's retirement and health insurance is not includable, right? And nothing there. They may actually rule differently on those too, because when you look at an S Corp, health insurance gets added back to wages and then deducted upon the owner's 1040, where a SEP contribution is only deducted on the business tax return. So I have a hard time seeing them throwing out a SEP, but they're kind of doing what they want here, right? So I'm not going to guarantee that. Another one I saw here a couple of times was, what about family members? Unknown. So
an idea if you're pushing the boundaries, just pick which ones you want to.
Right. So, you know, this comes down to, is there attribution rules among family or not? If there's not, there's also the thing you have to consider, what's the impact in community property states. So take Texas, which is community property state, right? That means if one spouse is an owner, the other one's an owner. And then, you know, if it was wife's company and they're both deemed owners because it's community property, husband wasn't on payroll, husband can't be on payroll now, right? If it's not community property state, then theoretically you could, right? Because husband was never on payroll, we hire him, we're paying full. I have a hard time believing that they're going to say no to spouses, because some of these businesses, truly the spouse stepped in and started working really hard. But I can also see them being very conservative and saying no. Same thing goes for kids. I don't know these answers. And
the intent of the bill is to keep people working. And again, all of those scenarios, those are week 6, 7, and absolutely 8 scenarios. So
right. And because we have lots of flexibility now, because remember, you could hire that spouse, if this works, hire the spouse, do a $13,000 signing bonus, and it works. Like, you truly could do this.
Okay, I got a better one that here's a better suggestion of a creative way to use the funds that would really, really work, right? If there's no better time to have the government pay for a project that you've needed to get done, such as doing a website, having project management, anything else where you can hire somebody that maybe previously you would have done as a, independent contractor, make the contingency that to do the work, they have to become a W-2 employee. If you're working enough hours, you can increase your headcount that way. You'd be able to use the actual wages. That's a good way to utilize the money to build the business without as much of the hustle.
I'm just saying, if the spouse comes up, to Matthew's point, this is not probably a now decision. This is a 6, 7, or 8, because you now have the flexibility to make that work.
Yeah.
It's not like originally we were saying, oh, you need to hire the spouse right away because you're going to need something in each of 8 weeks if you wanted to try that strategy. Now you don't need something in each of the 8 weeks. You can do one bonus, and they're looking at the whole 8-week period. So while I agree with Matthew, it's probably which boundary do you want to push? It's also a boundary you could push at the last minute, and it doesn't make a difference whether you push now or then. Absolutely. After you have some guidance. Just a clarification on owners, they do not count in the FTE calculation. But if you have no reduction, so if it was owner and owner now, which means it was 0 and 0, you actually get to put a 1 in the FTE calculation from the safe harbor, and it won't impact your forgiveness. So to clear that up, if you only had an owner before and you only have an owner now, or even multiple owners before and multiple owners now, forgiveness is not impacted.
All right.
Kathy, you asked, if we replace a higher wage employee with a lower wage employee, are you going to be hurt? So right now, in that wage and salary reduction, there is no exclusion for somebody who quits. There is in the FTE side, there's the FTE exclusion, but they are not excluded from the wage calculation. Something I think that will be fixed in the long run. But right now, if somebody quit and you replaced them with somebody else, you would be hurt in that wage reduction. Now, I also believe because you had a 0 and now you have wages, I have to go work through that calculation again. You may end up with a positive in that wage, which would negate some of your other losses and wash some of that out. But if you cut $10,000 of wages and had $5,000 on the new person, you clearly are going to have a $5,000 wage reduction in there as well.
All right. Thank you very much, everybody. I really, really appreciate you sticking along with us all the way through this. Jacob, thank you so much for taking the time to do this as well. We literally talked about this Friday night to get this pulled together for tonight. So we really hope that this was helpful. We hope that it makes starting Monday a little bit easier. And here's wishing everybody a very successful week. Thanks, guys.